Hello value investors, thank you for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today I want to talk to you about OpenDoor Technologies. I'm going to just discuss its business model, then I'm going to talk about its revenue growth rates and how they're going to come up quite compellingly against last year's comparisons, but that is not the full story. Then we're going to go through its path to profitability, and then we're going to talk about its valuation. So let's get started. At the surface, OpenDoor Technology has this premise that it's a platform where homeowners can very fast and conveniently dispose of the most prized asset, their home. Okay, so they have a home, for some reason they need to dump it really quickly, this thing that they've got all their emotions tied up to, and they go to something like OpenDoor Technologies and they're able to get cash offer very quickly and move out at their convenience. Okay, so that's the premise, right? And a lot of people are really bullish this company, so I wanted to try and do an Adam Grant here, and I wanted to kind of think this through again because I've been quite bearish on this company, so I just wanted to kind of try to see things from another point of view. Okay, so highlighted here from the investor presentation, you can see that compared to a traditional sale, there are sometimes, often to be honest, costs that come up on the side from trying to sell your home, and that it always takes a lot longer than you thought it was going to take, and it typically falls through. So with OpenDoor Technologies, it's clean. You don't have to spend a lot of time prepping the house. You don't have multiple viewings. You just take a few pictures, put it online, and then you get an offer, and it's all cash offer, and you can sell it and move out whenever you want. Fantastic, right? Now, here's the thing. There's a booming house market right now. So compared to last year, as you can see here in the graph, the company was really negative in Q3 and Q4. So compared to last year, any comparisons when a company is negative 70% is going to come really, really strongly. And also, we talked about already, there is a booming house market. People are just, desperate in the US to move out of living living in the city, and want to go out slightly more to suburbia because they're just traveling a few days a week to work. So there's a lot of movement, right? So on the surface, this looks really kind of like it's going to about to take off. Its guidance for the next quarter is for about 1.1 billion at the high end. So it's not inconceivable that in very near term this is coming up to about 6 billion run rate. It's possible, very possible. So a company that's valued at 9 billion, for it to be making close to 6 billion in revenues, that's very, very attractive. Okay, now here's the problem, right? So ultimately, the more that OpenDoor Technologies grows its revenue, the more it has to build inventory. The inventories is the houses. So you're in a position where you have to leverage the balance sheet and you have to acquire more and more houses. And people are not going to be selling the houses that cheaply. Yes, I feel people want convenience, but you're not going to sell your house at a huge discount just because someone is willing to give you a cash offer. You're going to be a bit price sensitive, because if you only have one asset to sell, it's a low frequency, it's the lowest frequency you can go for, and the person is only going to sell the house once every 5 or 7 years. There's not a lot of loyalty going to be built up. It's not like you're going to Costco every another month. The inventory is going to tie up a lot of capital. So that's one problem, right? The next problem is that if you look at its gross margins, let's say in the best case that the gross margins come up about approximately 15%, to be generous. Now, the contributions from the buying and the selling the houses is coming up to about 10%. And then after that, it's just all that capital has to be going back into the business. It's never going to be a very strong free cash flow generating business, because whatever they make, they have to buy more houses. I just struggle to see how this is particularly attractive. Now, let's just, for the sake of discussion, okay? So, during this booming period, over its trailing 12 months, let's say it's made close to 200 million. Now, 200 million profits. after paying the interest. I mean, it's not a lot of wiggle room for a company that's priced at 9 billion. You're talking about kind of 40 times, 45 times earnings. It's really, really expensive. Now, here's a few more ideas that I had. Okay, so does OpenDoor Technology have some kind of impregnable moat? Not really. I just noticed that Zillow Group is doing pretty much the same thing. So Zillow Group is in the US. It has a website where you can display real estate, but now they're kind of going into this thing where they're actually buying properties also. So you already have a competitor there. Then obviously you also have all the other real estate agents that are also doing the same other things. They're buying and selling property. Then you also have to think, okay, if we look out several years from now, let's say that on operating margins you're talking about 10%, because obviously you already discussed contribution margin is 10%. So let's say all factored in, including stock-based compensation, you come in at approximately 10% operating margin. Then you're going to have a huge over-leveraged balance sheet, because that's the cost of doing business. They have to take on a lot of debt if they're going to buy properties. So after the interest is factored in, you come into approximately 7%. It is going to be very, very difficult for a company with 7% earning margins to come up with a multiple to sales significantly higher than that, because it's a low frequency. It's not like Amazon where people are just stuck in. And also remember, in the case of Amazon, it's really the AWS side of business that is really valuable there. I mean, the retail side is okay, and that's what it started, but it's actually AWS is really, really valuable. So I'm not sure that it would significantly re-rate much higher, because it's a very, very volatile business, buying and selling houses. Because right now there's a booming market, but as you remember in 2008, wasn't really a booming market. So investors are savvy, and they're not really going to be willing to pay a very large multiple for that. So try to kind of offer a balanced argument of the good and bad points. Yes, there is a booming market. Yes, the appearance of one-time sales for what is called a technology company has the potential to re-rate higher, but then once you actually get into the details, I'm not sure that it's ever going to be a very profitable business, and it's going to end up with so much debt on its balance sheet, and it doesn't really have anything of a moat to really get the customer sticking around for very long. So these are some of the thought processes that I had. For me, I'm going to be looking around for slightly different businesses, something that I feel that is cheap but probably misunderstood. So if you're interested in that, come and check out my marketplace. It's called Deep Value Returns on Seeking Alpha. You're welcome to do a totally free trial to see if it suits you. Cancel anytime before 14 days, and if you like it, stick around, and yeah, I'll see you soon. Bye.